I think the total addressable market is extremely large, right? Because if we think about the wider bond universe, that's like $400 trillion of capital. And today they have 0% exposure to Bitcoin. Today they have lots of exposure to real estate. Real estate's constantly falling apart, right? That's the depreciation. You constantly have to reinvest in it. The market dynamics are constantly changing, whether it's because of work from home or migration patterns of people moving to Florida, people leaving Florida, people moving to, Nevada and then leaving Nevada, people moving to California and leaving California. All of that real estate collateral, I think that has been itself very volatile, right? And so when you're looking at constructing a credit portfolio, what you want to do is have allocations that are non-correlated.
Pierre Rochard, thank you for joining us on the Byte Federal podcast. How are you?
Very well. Thanks for having me on, Paul.
Awesome. So you've got some exciting news with the Bitcoin Bond Company, and you come at this space from a unique perspective in that you have a deep financial background and a technology background, which is a unique combination. And so from that perspective, where does the Bitcoin Bond Company fit in your background and where you see the future of Bitcoin going?
Yeah, so my background really starts in high school when I was learning about Austrian economics and sound money, and at the same time learning about open source software and installing Linux on computers and whatnot. I thought those two would be pretty separate because back then sound money was just gold and silver. But then my last year of grad school, I was getting my bachelor and master in accounting at UT Austin. That's when I discovered Bitcoin, went down the rabbit hole. And ever since then have had a number of different roles in TradFi and also in the Bitcoin industry. And so, if we look back at 2013, 2014, the SEC was very anti-Bitcoin, and really so was a lot of Wall Street. I think a lot of Wall Street was very focused on blockchain technology, not Bitcoin, was kind of their mantra. Um, that all changed over the past 12 months. So we can point to the fact that the SEC was forced to approve the ETFs with, contrast that the first ETF was proposed by the Winklevi twins a decade ago, and that got denied by the SEC, even though really it was a completely uncontroversial product. Um, but I think it took the growth of the market, but also just the litigation and the fallout from GBTC to push forward a real set of products from mainstream financial institutions, and the biggest one being BlackRock. So we went from the CEO of BlackRock, Larry Fink, saying that Bitcoin was an index for money laundering, to him saying it's digital gold, sits above governments, and kind of recognizing the extraordinary sovereignty of the Bitcoin network. Um, Second is the election of Donald Trump. So, or the re-election, right? So that, I think, was in no small part due to a lot of the far left progressive policies that were being pushed by the Biden administration. And when it comes to Bitcoin, they decided to start an all of government attack on Bitcoin. So that ranged from imposing capital controls with what we call Choke Point 2.0. Came with attacking the Bitcoin mining industry and trying to dox all of the electricity providers for the industry in order to pressure them into canceling their contracts with Bitcoin miners. So that attack did cause um, an immune response, right? The white blood cells that came and to defend the industry, and not only just defend it, but then go on offense. Because when we go in to talk with staffers and legislators, on one hand, we want to talk about um, the flexibility of Bitcoin mining as an electrical load, and the lack of environmental impact of consuming electricity, right? All of the environmental impact is on the production of electricity, potentially, right? Assuming that it's not solar and wind and all of these other renewable resources, or nuclear for that matter. Um, but in addition to kind of highlighting the lack of harm on the electrical side, we also did a lot of education emphasizing the benefits of Bitcoin. Why is it that Bitcoin mining is not wasteful, and is actually powering the most advanced decentralized monetary system that has and will continue to grow by leaps and bounds, and why politicians need to align with it rather than try to fight it. So I think that we were so successful that not only did we push back on the attack, but we ourselves went on offense and started promoting strategic Bitcoin reserves and policies that are really pro Bitcoin and not just defensive in nature. So, um, with the election of President Trump, he came with a lot of um, desire to change the SEC, because the SEC, it had not just been a problem for Bitcoin aligned projects like the ETS, but also for the wider crypto sphere. So Gary Gensler essentially had a reign of terror on the crypto industry, preventing them from issuing all of the tokens that they want to issue, which, we can disagree about Bitcoin maximalism and all of that, but just setting that aside, it created a political dynamic where the SEC was under tremendous pressure for significant reform. Um, that came in the form of appointing Chairman Paul Atkins, who has a very, very different view on the value of the crypto industry than Gary Gensler did. um, Really a complete 180. And he's focused on saying, well, let's let the investors decide. What kind of risks do they want to take, rather than thinking about how to prevent investors from taking risk, which was really the Gensler philosophy. And Gary Gensler, I think that if we were to probe him, uh, he might actually be more sympathetic to the free market approach. But he was nominated and confirmed by the Senate, uh, thanks to Elizabeth Warren, and so he owed a debt of gratitude to her. And so he, I think, was boxed into having the same policy views that she has, that are very anti decentralization. We can get into the psychology of Elizabeth Warren. I think that she's got her set of issues, but um, Paul Atkins is merit neutral and is really interested in just letting investors make their own decisions, as long as everything's properly disclosed, right? So making sure that nobody's stealing, and that nobody is misleading investors, so that we have an efficient capital market here in the U.S., which is really the biggest capital market in the world, and it's the envy of the world. And so in many ways, it's a crown jewel that has to be protected as the engine of capitalism, and what has allowed us to have this level of prosperity. So that kind of gives you a lay of the land from a regulatory perspective. And then from an investor perspective, what we've seen is that lots of retail investors have benefited from the fact that Bitcoin's a commodity, and that they can just go onto an exchange, or to a Bitcoin ATM, and to acquire Bitcoin at the retail level. And so what we've seen over the past 10 years is that Bitcoin has been a retail driven phenomenon, and that it's been bottom up, grassroots, growing Bitcoin from $0 in 2009 to now a $2.1 trillion asset. So that did not go unnoticed by institutional investors. They look at that growth rate and they have to shift their thinking from, all right, they poured billions of dollars into blockchain technology, got zero return on investment from that. Meanwhile, they look at Mr. Saylor, who has poured billions of dollars into Bitcoin and has gotten a tremendous return on investment for his shareholders. And that has, I think, caused a fundamental shift in their thinking about Bitcoin from it being too risky to it being very lucrative. And so now what they're trying to figure out and what the Bitcoin Bond Company wants to help them with is understanding how to access Bitcoin. Because a lot of portfolio managers, it's completely outside of their mandate to hold a commodity. It's just not what their funds are set up to do. And some of them have a mandate to hold equities. And so they've been able to buy MicroStrategy, even in some cases buy ETFs like IBIT, and a lot of these other new Bitcoin treasury companies that are unfolding as well. Um, but a lot of other portfolio managers are purely in the credit space. And so they need credit wrappers around Bitcoin in order to access the risk return profile of Bitcoin. And so that's what we intend to do with the Bitcoin Bond Company. So, that it leverages my background in securitization. So when I started my career at Deloitte, I was auditing mortgage-backed securities and all sorts of other credit instruments. And so it's a world I'm very familiar with. And that felt like a natural fit for me as we accelerate Bitcoin adoption into the 21st century.
Wow. Yeah, Pierre, that's I love talking to you because you've been on this journey with Bitcoin for so many years and you've fought the political and regulatory battles, you fought the mining battles, you fought the investor adoption battles. So you've really got a deep and broad perspective on this space. And it's really, I mean, that was a fantastic summary going back from my whole history in Bitcoin and watching all this stuff play out. So anybody who's new here, it hasn't been just, oh, here's Bitcoin, everybody loves it, and we're off and running. It's been, you reminded me of a lot of fights and a lot of shaky nerves over the years. So that was a great summary. Um, so who do I mean, I understand where you're going with the Bitcoin Bond Company, but I want to make sure we simplify this for people that might be new to the space and might not have the financial background. So talk to me about who you see your initial customers being for the company. What kind of organizations would be issuing these bonds, and then how you might structure different offerings with Bitcoin to add the Bitcoin exposure, but keep it into an instrument that a bond manager could bring into their portfolio.
Yeah, so first we got to look at what happened at the financial crisis. I think that that's really key to understanding what the credit landscape is like today. So after the financial crisis, they passed Dodd-Frank, as well as a lot of regulatory changes on banks. So that's the Federal Reserve, the OCC, um, the FDIC, that all of those, what they would consider to be guardrails and enhancements, what the banking industry might consider to be tying their hands, has caused the commercial banking system to really be limited in what kind of credit it can extend, broadly speaking, and how much they can leverage their balance sheet versus hold in reserve. And um, that created a void in the market that then actually created an opportunity for what we today call private credit funds, which are essentially providing those commercial banking services of lending to businesses and to consumers, using money that is not coming in through the banking system as demand deposits or as CDs or as new creation of money, right, through the fractional reserve banking system, but rather are coming in through LPs that are institutional investors. And so these private credit funds have grown to now, they too are on the same scale as Bitcoin, right? They're over $2 trillion of AUM. Um, and that they are what some would disparagingly call the shadow banking system, which I think is completely inappropriate. I think that they're actually a lot better in many ways than the commercial banking system because they don't create that maturity mismatch between the demand deposit that can be called at any time, right? What we call a bank run, and then that requires bailouts and the FDIC and all of that. Um, Instead, the capital contributions to these credit funds, it actually matches the duration at which they're lending out, and so it's a really, I think, a much better setup from a macro prudential perspective. Um, it also means that they have a lot of flexibility in their mandates to be able to craft loans that are customized to the underlying businesses, to the underlying collateral, to make sure that they get paid principal and interest, but also that the borrower is able to create economic value that is driving ultimately that return for the investors. Um, so, uh, given that the a lot of the credit system has shifted away from commercial banking into credit funds, when we think about how to finance Bitcoin and how these credit funds can access Bitcoin, what they need is two things. One is a credit wrapper around the Bitcoin. So, a kind of a private placement, a 144A type of security that is a note, right? And that isn't just an equity or a commodity. And two is the risk transfer. So some funds are interested in having less risk and lower return. That's their mandate. And so they are gravitating towards more senior secured positions in any kind of capital stack, whether it's in Bitcoin or in a business, meaning that if we look at the example of a business, if the business goes south, and we look at the whole capital structure, that they might have lent to the first 20% of the capital structure, and so even if the Bitcoin, or sorry, if the business or the Bitcoin loses half of its value, that the creditor is still protected because they're only lending against the first 20% of the business. And then in between, you have the mezzanine lenders who are looking for that higher yield, higher risk, and that's really, um, where they are more aggressive, while still protecting their downside. So they're not quite lending against the equity of the business. And then at the top of the stack, you have some combination of equity investors and junior investors. So the juniors, from a credit perspective, are the first loss. And so if the business or the value of the Bitcoin goes down, then they are really, so the kind of investor that goes for that is the distressed credit funds. And so they're looking for opportunities where there is asymmetric opportunity, right? Where if they can fix up the business, or if Bitcoin goes up in value quite a lot, then they stand to benefit from a leveraged position. And if things go south, they get wiped out and they lose their whole position. And so when we think about adapting Bitcoin to a credit portfolio, it is that combination of wrapping Bitcoin in credit notes and then reallocating the risk among those notes so that the senior has more security, but also less returns. And then the junior has greater returns and less security. And so that's really the crux of what securitization does. And the economic value of it is that it cracks open Bitcoin's risk return profile to a much wider range of investors than spot Bitcoin. Because even if we set aside the question of commodity versus credit, there's lots of investors out there who think Bitcoin's too volatile and they want something that is less volatile. And then there's a whole other set of investors who want to try to outperform Bitcoin by taking on leverage. And we've seen them For example, they'll go buy Solana and Ethereum, right? They're trying to outperform Bitcoin by taking on more risk. They've been really disappointed by the outcomes of those strategies, and so they're looking for cleaner alternatives that really speak to the fundamental economics at play here, which is that Bitcoin as a monetary instrument, the value accrual arguably is winner take most or winner take all. And so they need to focus on tranching up the risk return of the winner rather than trying to diversify with losers.
So, Pierre, do you see your role as working with companies that have a need or the funds that want to make the loans? Meaning, will you be structuring deals where a fund says, "Hey, we're interested in investing in this company, but we want, and we'll lend X million dollars, but we need the company to secure that loan by holding some Bitcoin," or will you be working with companies like miners or Byte Federal and others that are saying, "Hey, we want to raise some funds, and we're willing to put some Bitcoin maybe out of our treasury behind that to securitize that loan." What is the angle here for your company, or maybe it's from both sides?
Yeah, so I definitely think that there's going to be opportunities for companies to be intermediating credit with Bitcoin companies. What I've really focused on, which I think is something that's very different than that, is that there's a lot of lenders who they 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 already view Bitcoin's risk itself as risky, and that they want to remove all corporate risk from that. So, if they want corporate risk, there's lots of other avenues for that. We see like Unchained, for example, or Strategy, for example. What what is differentiated here is putting the spot Bitcoin in cold storage with a trustee that is really isolating the collateral from any kind of corporate counterparty risk. And so that way, the only question for the credit investor is, where do they think Bitcoin's going to go? They don't have to have any concerns about any other kind of third party risks from a credit perspective. Now, obviously, there's the third party risk of, is the qualified custodian, going to accidentally lose the private keys? Those are always existential risks. And then there's the existential risk of, will the Bitcoin network, continue to function and operate? But they're not taking on corporate credit risk of, will this counterparty be servicing the loan or anything like that. All of the returns, all of the principal and interest payments ultimately would come out of the capital gains from holding spot Bitcoin in cold storage. There's no other rehypothecation or yield strategies beyond that, because then that just complicates the underwriting process and the due diligence for the credit investor who's really just looking for Bitcoin exposure.
Gotcha. Interesting. Okay, so are y- I guess I'm a little bit confused is if the Bitcoin bond company is going to be putting these structures together or advising lenders or advising corporations that want to raise capital this way.
So definitely the latter, right? So when we think about a traditional securitization, you'll have the originator, which is originating mortgages, let's say, warehousing them on their balance sheet as an asset, and then securitizing them, moving them off their balance sheet into a bankruptcy remote SPV, and that trust holding the mortgages. And then the originator really becomes, their role is limited to being the servicer. They're not the ones that are holding the risk. So that's that's really the dynamic here. Is the Bitcoin bond company is the sponsor. Now, thankfully, we don't have to originate any loans. All we have to do is, after the capital has been raised, the proceeds go and buy spot Bitcoin and hold it inside the SPV for the life of the vehicle, and then liquidate the Bitcoin, go through the cash flow waterfall, and pay out the returns to the investors.
That's fantastic. Wow. So that, I mean, that's really going to be something I think that's attractive to uh, a wide range of both public and private companies trying to raise capital. Do you see like, like, I guess, where do you see low hanging fruit, and then where do you see the future of this going across the wide swath of companies we have here in the United States?
Yeah, so and this product is really not for companies at all. It's really
Okay.
for the credit funds and institutional
Okay.
investors who want as thin of a wrapper around Bitcoin as possible to have that exposure in their portfolio. And so, if you look at the leverage long piece of it, that might be attractive to a macro hedge fund, right? That is really interested in they're bullish on Bitcoin, they understand, NGU technology, and so they're swinging for the fences. And then on the other end, you might have more conservative. It might be an endowment, a pension fund, insurance fund that is interested in um, having a constructive view on Bitcoin, but also having downside protection because they understand that it's very volatile and that doesn't fit within their mandate of just spot exposure.
Wow. Okay, I didn't realize that. That's really interesting. So they can, along with your help, spin these up um without much friction at all. Would that
That's
be
right.
accurate? Yeah. Wow. That's interesting. So then where do you see as for the size of the market for a product like this? And then, of course, to us plebs, how much Bitcoin is going to be bought through a vehicle like this?
Yeah, I think the total addressable market is extremely large, right? Because if we think about the wider bond universe, that's like $400 trillion of capital. And today they have 0% exposure to Bitcoin. So today they have lots of exposure to real estate. Real estate's constantly falling apart, right? That's the depreciation. You constantly have to reinvest in it. The market dynamics are constantly changing, whether it's because of work from home or migration patterns of people moving to Florida, and then people leaving Florida, people moving to Nevada, and then leaving Nevada, people moving to California and leaving California, and so all of that real estate collateral, I think that has been uh, itself very volatile, right? And so when you're looking at constructing a credit portfolio, what you want to do is have allocations that are non-correlated, and so that's where it makes sense to say, well, we're going to have not just real estate exposure, not just corporate exposure, not just munis and state debt and federal, but also have collateral that is Bitcoin, that is this digital native capital that you can think about it as they're lending to a developing country that is in cyberspace and has a completely different dynamic than all the rest of the collateral in their portfolio. And so when we think about the fact that they currently have a 0% allocation and that they have to develop, in order to be diversified, they would need an allocation that is anywhere from 1 to 5 to 10%. It's just a massive opportunity that is untapped and is really only limited by their education, right? So that's the big hurdle here. All of the work is in the education of these investors to get them past all of the misinformation that has been spread over the past 16 years of Bitcoin's life about criminals using it, about it being too volatile, and that it's beanie babies and tulips, and breaking through that so that they understand that the fundamental software engineering of the system is architected to really be the most reliable monetary system and to drive adoption to greater and greater heights over the coming decades and centuries.
So when you're having those educational discussions, are how much of the discussion is about the future of the dollar and US debt versus the structure of creating these bonds?
Yeah, so I think that the future of the dollar and U.S. debt is top of mind
It is,
for
okay.
credit investors because we just saw Moody's downgrade the federal debt Now, whether that was symbolic or real, I'll let the market decide on that. Um, and so the issue for a lot of these investors is when they look back over the past several years with the COVID inflation, there are concerns about inflation picking up again. And so they want credit instruments that not only diversify their collateral base, but also provide some degree of inflation protection. That is an asset that, if there is a pickup in inflation again, that asset will outperform the inflation and will pass along that return to the credit investors. And so I think that it goes hand in hand where you want to have a structure that is designed to pass along the upside to the investors and is not just capturing all of the upside for the equity holders, which is the case for a lot of other Bitcoin-backed credit products.
Interesting. So do you foresee that this is going to be something that gets adopted as, say, a rate like an emerging market exposure of maybe 3 to 5% of a portfolio, or something that will become much greater than that?
Yeah, I don't know. We'll
Okay.
see. It's a good question.
Interesting. So w- I, I want to well, let's jump away from the Bitcoin bond company discussion and into sort of the more macro view of having so many corporates and funds, whether that be through direct exposure to Bitcoin in a treasury or through a Bitcoin bond. What does a future look like where we have so much institutional holding and exposure to Bitcoin? And how do you see that um, changing Bitcoin's trajectory, or the experience of owning Bitcoin like we've experienced over, say, the last 10 years, where it's been mostly retail? How do you see that changing this landscape?
Yeah, in many ways, it doesn't really change anything in the sense that a lot of retail investors have held Bitcoin at Coinbase, for example.
Hmm.
Coinbase holds 10% of the Bitcoin. Before that, it was Mt. Gox, right? That obviously did not end well. And so I think that a lot of retail exposure has been uh, through institutions. And that, so in that sense, it doesn't change anything. It also doesn't change anything in the sense that individuals will continue to have the freedom to be self-sovereign. So if that were to be infringed upon or undermined by institutional adoption, that's a huge self-own because a lot of the underlying value of Bitcoin comes from the fact that it's permissionless. So if that changes, then that would cause the value of Bitcoin to suffer, and so all the institutional investors would be undermining their own investment. And so it really is a very symbiotic relationship and complementary rather than substitutive. So I think that the biggest problem right now is that there's a lot of people who like Bitcoin. They're not anti-Bitcoin by any means. They are just not computer savvy, first of all. So, I take it for granted. Like I was installing Linux in my parents' basement. That's totally fine to set up a hardware wallet. Not a problem. Happy to do that. Um, but that's not representative of the wider population, right? So most people are freaked out by hardware wallets. They don't understand how computers work. It's all magic to them. If they mess it up, they lose their entire life savings. And so it's just something that um, has had a lot of investment put into it of like, let's make Bitcoin easier to use. Let's make more user friendly wallets. Um, and yet when I have conversations with normal people, it's completely outside of what they're comfortable with. So at the same time, they do the math, right? Of like, well, there's only 21 million Bitcoin. You have infinite demand. So obviously the value is going to increase. And so they want to have exposure to it. Uh, and you have lots of, for example, you might have teachers that have uh, defined benefit plans where they're contributing, and it's being managed by a third party. And so that pension fund ultimately, if they don't have any Bitcoin exposure, they are underfunded. They're not going to be able to meet the benefits that their stakeholders are expecting of them. And so that's where it really is absolutely necessary to have institutions holding Bitcoin, not for Bitcoin's sake, right? Like Bitcoin doesn't need them; they need Bitcoin. And so I think in many ways, it's really not going to affect Bitcoin. This institutional adoption, it's going to affect institutions and
Yeah.
the people that are depending on them for retirement or for insurance claims or whatever else the end use of it is, for the arts, right? For endowments, for university education, all of these, that if they only hold underperforming assets, ultimately they're not going to have the resources needed to fulfill their mandates.
Yeah, it seems to me that, I mean, the institutional investor space is kind of living quarter by quarter, right? And their performance and their ability to survive and where they rank in gathering additional funds to grow their products. So if in a bull market, I could see when you're outperforming your peers that you're going to want to get involved in this as quickly as possible, or if you're underperforming against your peers. But on the downside, if you're looking better because you don't have Bitcoin exposure, and you didn't drop as far, or is that going to incite more selling? So is there more of a churn on Bitcoin now that we have more institutional holders, as opposed to folks like us that just buy and hold forever?
Yeah, we're very much in the minority, right? And so if you look at the median hold period for Bitcoin, it's 2 years. Right. So retail is very vulnerable to FOMO on the way up and panic selling on the way down. Um, I think that at the margin, institutional investors are probably a little bit less vulnerable to that, both on the upside and on the downside. But you're absolutely right that they're not immune to it either. And so if we look at how long is the median Bitcoin held, it started at 0, obviously, and it has gone up since then. I think that it'll continue to go up. So 2 years will become 3, will become 4, will become 5. Um, but if we look at individuals too, there's always, beyond just panic selling at the bottom, there's profit taking at the top. So an individual who held from $1 to $100,000, they're going to want to take chips off the table, whether it's to buy a Lambo or more charitably to give to their favorite cause, or to pay off their mortgage or put their kids through college, whatever it is. They're going to take chips off the table, and we've seen whales selling at 100K because of that effect. Where yeah, they've held through a lot, and to their credit, they deserve to. They're entitled to hand the baton off to the next wave of adopters.
Mhm.
And so a lot of investors, yeah, they might have quarterly benchmarks, but they also might have multi generational mandates, right, where they are perpetual funds and that they're going to hold that capital forever. The other big question is, how are they being marked, right? So if they're holding spot Bitcoin, the mark to market is really easy. If they're holding a credit wrapper around Bitcoin, the mark to market then has to factor in the recovery rate for Bitcoin. And so they come to more of a mark to model approach where if they had the view that Bitcoin generally recovers over a 5, 10, 30-year period, that they don't really need to mark down the impairment in one quarter just because Bitcoin's being volatile. Everybody knew it was going to be volatile, especially if the credit instrument actually has built in over collateralization through subordination. That in fact, even if they were to mark to market, it might not even hit the impairment threshold. And so they might add to their position opportunistically and say, hey, this is actually a great entry point, and they're dollar cost averaging like a pleb.
Yeah, interesting. I hadn't thought about that. That's really good. Um, so, a lot of there's a lot of talk these days about there being a massive supply shock, right? And Bitcoin's going to 1 million in this cycle. And then you have on the other spectrum a more conservative view that we have broader adoption and volatility is compressing, and something more like 150K is going to be the upside of Bitcoin. So where do you where do you kind of square this, all this input, right, between institutional adoption is going to take us to the moon, or institutional adoption is going to sort of um, subdue the volatility in Bitcoin? Where do you land in that space?
That's a great question. So I definitely see arguments on both sides that are valid, and so it's tough to shake it out to a net outcome. I think that first we have to start with the fact that past cycles seem to have been triggered by the halvings, right? Where Bitcoin new issuance through the mining process gets cut in half every 4 years, and that had a big effect in the early days. It seems to have a smaller and smaller effect because at this point, 95% of the Bitcoin have already been issued. Um, and so the halving is really, marginal compared to that overall float. So if we rule that out and we say, well, going forward, Bitcoin price is really going to be driven by incremental adoption on one hand, and then on the negative, it's going to be driven by incremental um, rebalancing of existing holders selling. And so the sell pressure is not coming from new issuance anymore. It's coming from OGs that have a bag. And so, if we look at the past year, we could say, well, that run up was driven, first of all, by the ETFs being launched. So, the bottom of the bear market, December of 2022, was 17 grand. Now, now we're at 100 grand. And so I think the ETFs plus the new regulatory regime, um, and Trump signing the Strategic Bitcoin Reserve Executive Order, so legitimizing the asset class at a sovereign and institutional level, we could say that's what caused us to get above 100K. It was not necessarily the halving, because the halving was just so small relative to the float. Um, and that going forward, it's just going to be this constant dance between new adoption from institutions and retail cashing out gains. And so, um, where does that shake out? I don't know. I think that uh, there's also eventually you run out of sellers, right? So that's what then causes the price to go up to attract another wave of sellers. Um, and you'd have to wonder, well, if 100K didn't trigger you to sell, does 200K? Maybe, maybe not, right? Like at the margin, yeah. But maybe the next wave of sellers, they would really be incentivized to come to market if it was at $1 million. And so it is going to need a massive run up to bring them out of their cold storage and to, let go of some coins and hand them over to the institutions. Um, the other really interesting thing is the development of this whole space of derivatives around Bitcoin, right? So you have the first derivative, which let's say is MSTR, of holding spot Bitcoin on their balance sheet and issuing common stock to finance that. And then you have the second layer of derivatives, which is um, Saylor issuing the preferred stock. So Strife, STRF, and STRK, which have different trade offs versus the common stock. And so, from an equity perspective, you have lots of retail investors who are like, well, I made a lot of money off of holding spot Bitcoin that I rolled into MSTR back in 21, that then made a lot of money off that, and then rolled that into something less risky like STRF that has a 10% yield with downside protection. And so if you look at the price of STRF, it's really interesting that like it's Bitcoin price will be going down, MSTR will be going down more, right? Because it's leveraged. and then STRF will be going up a little bit because you have people who are, in real time going to something less risky. Um, and then you have the third order derivatives, which are like MSTY. These are wrappers around options traders that are harvesting volatility off of MSTR, which is more volatile than Bitcoin because it's leveraged like Bitcoin, right? So um, MSTY has $3.5 billion under management today. And their, past performance is no indication of future performance. It's highly risky. All the disclaimers. They have 100% annualized return off of their income product, and so I think that it's really a huge question of, well, what happens like if Bitcoin goes to 150 and to 200, and you have these layers of derivatives that most of them are directionally long, right? So the downside scenario is Bitcoin goes to 50K and stays there, right? And all of these layers on top get wrecked. And so I don't think anybody thinks that's going to happen. And that's why these layers on top are flourishing, is that people are really oriented towards um, 50K has been de-risked. We saw even with all the tariff turmoil, Bitcoin really held steady in the 70s. And that was, you know, in an environment that was pretty challenging. So, what happens to capital markets and to Wall Street when they see not just Bitcoin outperforming their portfolios, but all of these Bitcoin derivatives massively outperforming their portfolios? It's going to cause a lot of um, what my friend Punter Jeff, as he puts it, is kind of the bewilderment, right? And we saw this with the Financial Times. They put out this video that was like, "Why is strategy buying Bitcoin?" And they still can't wrap their heads around the fact that you have this asset that is the scarcest asset in the world, and that when you have any amount of incremental increase in demand, that the price, you know, goes up and goes up a lot. Um, so I don't think that the wider capital markets have caught up to not just the financial performance of Bitcoin from 17K to 100K, but also that this is not tulips. This is
Right.
backed by software engineering. It's backed by a decentralized architecture, and that they need to actually do their due diligence on the asset and stop it with the nonsense of tulips and blockchain technology.
You just made me think. It sounds a lot like we've got smooth sailing until we see The Economist and Times Magazine put a headline out that says you can't lose money in Bitcoin companies.
Yeah, and we're so far from that. Um it's really astonishing, conversations I have with people where they just they've really have not thought about Bitcoin at all, and
Um,
furthermore, have read so little about it. They might even still spell it, with a capital C and a space in between the bit and the coin, right? Like they're just on a completely different wavelength. Um, and that is 99% of the world's capital today is
that's
just
amazing.
completely uneducated about the asset, and that is the opportunity. That's
Yeah,
why there's upside. If it
exactly.
if they understood Bitcoin and, they were posting memes on Twitter, there wouldn't be any upside left. Now, whether there would be downside or not, I think that's an interesting question. If like, at what point do we reach 100% adoption, and there's no like big new buyers, but there's also no big new sellers, right? And Bitcoin's value just steadily accrues based on the productivity of the economy.
Yeah, absolutely. Gosh, it's so hard to fathom that there's still so much education. I mean, I guess when you get into the space and you go down the rabbit hole, right, you spend I don't know how many hundreds of thousands of hours I've watched of content or read or I mean, it's just and you don't ever stop, right? And then so you just think you feel like you're behind the curve and everybody else is ahead of you.
Yeah.
But in reality, when you go out and do what you're doing with talking to these institutional investors, you realize the guys controlling the bulk of the money still have no idea.
That's right. We're in an echo chamber
Yeah,
of like there's maybe, like optimistically like 500,000 people who are just like fully orange pilled, right? Who just completely get it. And they're on X and they're going to the Bitcoin conference in Las Vegas or not, right? Like that's fine too. They're stacking sats, staying humble. And that outside of that bubble, um, like it's a different world. It's a completely different planet, different language. Um, and so, what I'm interested in is obviously building bridges, right? And increasing adoption and talking with folks who in the past have had no reason to try to understand Bitcoin. But going forward, they understand that they might be missing out on something.
no. So putting your policy hat on now and thinking about the strategic Bitcoin reserve, and the idea of a Bitcoin-backed treasury. What do you think about that, and what do you think of the prospects of that coming to reality?
So I think that it's gonna happen in phases. So the first phase is just holding what has been seized already. Um, and with the caveat that if through the judicial process, the people who had those Bitcoin seized from, if they turn out to be innocent, then we have to give those Bitcoin back, right? If they are guilty, then those Bitcoin are just going to be held as forfeited. Um, and then the second phase is um, identifying ways to capture more Bitcoin um, in budget neutral manners. So that might involve selling other cryptos, right? There's a crypto stockpile that is sell only. And so maybe converting some of the, Ethereum that has been seized
That's
into
interesting.
Bitcoin.
I didn't realize they was sell only.
Yeah, so they don't have a mandate to accumulate any other cryptos.
Except with just Bitcoin.
Yeah. So yeah, there's two piles. There's the strategic reserve of Bitcoin, and there's the crypto stockpile. And so they have very different mandates. Because ultimately the only strategic asset here is Bitcoin. The others are just kind of tokens, right?
Mhm.
There's lots. There's an infinite number of tokens, right?
Yeah,
Like
yeah.
anybody can issue a token tomorrow. So it only makes sense that there would be a differentiation at the federal level, and that differentiation is spelled out black and white ink on the executive order. There's no ambiguity about it at the federal level. So the other part of the second is identifying like ways that we could accumulate more. For example, with um, tariffs, maybe the tariffs should be paid in Bitcoin. Um, Maybe the royalties that are on, for example, oil and gas paid for on federal lands, monetizing those into Bitcoin. Uh, Even if we look at all of the real estate that the U.S. government holds, that it's just useless real estate for the government, right? It has no public value. Like it's not like a national park or anything. It's just, barren land that would be in higher use in the private sector. Um, and selling that for Bitcoin. Uh, Maybe even uh, assets held by the military. For example, a missile silo that just has no use today. Converting that into civilian use and selling that, or um, providing also. If we think about a strategic reserve, something that has to happen is the private keys have to be secured, right? Um, Today we don't even know how the private keys are being held. We don't know how much Bitcoin is being held. There's an audit that is in flight that the results were due last month. They still have not occurred. So there's a lot of open questions there. Once we get to a point where we have Fort Nakamoto, right? Like a federal multi-sig that has just the best sovereign grade security around it, I think it would make sense that for them to then offer that as a service to the private sector and to state and local governments to say, okay, we're going to have collaborative custody where we will be one of, a multi-sig quorum that is hyper secure. And so that way, we're able to monetize this new digital Fort Knox by partnering with the private sector, and then putting the proceeds of that into the Bitcoin Strategic
Interesting.
Reserve, right?
Interesting. Huh.
Um, and also, that third is looking at ways to lower the cost of the national debt by issuing bonds that have a combination of, yes, 90% of it goes towards paying off the old bonds and refinancing the national debt, 10% of it goes towards buying Bitcoin, and that the bond buyers actually get a upside on the Bitcoin. And so that way, for those who need sovereign grade credit, right, where it's backed by the full faith and credit of the U.S. government, um, and want Bitcoin upside, that then they will accept a lower interest rate and lower cash payment in order to benefit from that. And so that way, because right now the interest payments are like $1 trillion a year. It's more than the Pentagon. Um, so let's lower that by adding a Bitcoin kicker to the national debt, and that also means that the U.S. government is buying more Bitcoin into the strategic reserve. So that we have a win-win. So I think those are the three layers currently identified, and that it's just a matter of time and making sure that we do it correctly so that we don't lose any Bitcoin along the way.
Yeah, that the treasury bond with the 10% Bitcoin kicker seems so aligned with Trump's agenda to move manufacturing back to the United States and to keep interest rates low in order to help facilitate that. It seems like a natural fit for what he's trying to do. But I was just wondering how much, um, how much politicking and how much uh, discussion and fights there will be to get that in place. I don't, if that's really realistic during his administration.
I think that if we look at the outcomes from the most recent election, I point to the fact that Sherrod Brown, the incumbent Democratic senator who was the chair of the banking committee, lost to Bernie Moreno, a Republican challenger who was really, didn't have a huge track record in terms of election, outcomes, was driven by Bernie Moreno being very pro Bitcoin and pro crypto, and Sherrod Brown being anti. And so I think that from a voter perspective and also from a fundraising perspective, um, there's there has to be acknowledgement that this is the direction that the country's going in, and that anybody who stands in the way of that is destroying their career in politics. And so if there are, politicians who want to destroy their careers by fighting against good policies like this, that's to their detriment. I mean, I'd like to talk them out of it and talk some sense into them. Um, but the writing is on the wall, and
Yeah.
all they're doing is delaying the inevitable, and to the detriment of their own careers. So, um, I look forward to those policy fights, but I think it's just a matter of time.
So the Orange Party is continuing to grow and going to get stronger and stronger in your view.
Yeah, I mean, look, it's diametrically correlated with the Bitcoin price, right? And with people's
Yeah.
understanding of Bitcoin. And that's not slowing down anytime soon.
Right.
So elections have consequences. Arguably, Trump's victory was due to the fact that he developed a really strong coalition, whether it was with Make America Healthy Again, with RFK Jr., or with, making sure that all of the cabinet secretaries are pro Bitcoin, with Lutnick and Besant, who understand Bitcoin. I think that this is the direction the country's going.
Yeah, I think what's I mean, it's amazing the people that he's put in the administration, how pro Bitcoin this administration is, and that's what I think is a little. I think people overestimate how quickly things can change, even with those people in place. But so you're very hopeful over the rest of his term.
Well,
Bonds.
look, it might take longer than we think, and it might be in the second JD Vance administration in 10 years that we finally get the Bitcoin bonds. But things might also significantly accelerate out of desperation, right?
Mhm,
A lot of
mhm.
people turn to Bitcoin out of desperation, and that was the story with Strategy and with other Bitcoin treasury
Oh,
companies where they've run out of other options. And so, if we have a fiscal crisis and they need to sell bonds, and they need to have creative solutions to do that, it might happen suddenly.
yeah. In that regard, it. I mean, that's sort of the way I see the future going. If I had to read my crystal ball, so it's good that that discussion's on the table now. Um, so let's talk about mining and op return. I'm wondering if you've got any thoughts on what's happening in that debate with Core and Knots and with your mining background, if you have an opinion.
Yeah, so there are two debates that will continue to always happen within Bitcoin. Um, when there is less demand than supply for block space, the debate will be about spam because it will be economical to put spam into the blockchain. And then when there's more demand for block space than there is supply, the debate will be about the block size limit and increasing that because transaction fees are too high and it's uneconomical to get monetary transactions into it. And so we will just, as a community, oscillate on that pendulum back and forth until the end of time, as my thesis on this. And that's totally fine because it's not like either outcome destroys Bitcoin. Bitcoin's anti-fragile, and the users will adapt to the resources that they have in front of them.
Okay. So I mean, so then this do you think this lends towards ossification, or do you think it lends itself to incremental changes as these battles ebb and flow back and forth? Like, do we get uh, uh, pressure on block space, and then we adopt covenants? Do we get cheap block space, and we're more open to JPEGs? I mean, is it, or is this we're ossifying and there's going to be no changes? We're just going to be arguing.
Well, I would actually I would put the debate over opcodes as orthogonal to the debate over the use of block space. And so, like increasing the block size limit um, has been, uh, I think, it was tied with SegWit. It was tied in there with whether it was tied in there with the witness discount or with the 2x, hard fork. Um, but that I think was a one time thing. I think that going forward, increases in the block size limit will not be tied to changes in opcodes or in Bitcoin scripting language. Um, that's really about how efficiently do we use the block space, not how much block space is there. Um, and then on the spam side, that will just be endless. And so, but that's not really related to the opcodes. So you can have spam without any changes to opcodes. Um, and I haven't seen any opcode proposals that would make spam easier to include in the blockchain. Um, so I think that there will be, you know, between those two debates I pointed out of spam versus increasing the block size limit, then there's orthogonal debates about what changes to Bitcoin opcodes should we adopt. And I, you know, the argument for ossification would be that the first debate causes so much acrimony and balkanization between different camps that then the second debate about opcodes becomes socially unscalable. and that there's no possibility to have rough consensus on new opcodes. I'm skeptical on that. I think that really what it's about is the cost benefit analysis. The benefit of a new opcode has to be uh, really a 10x improvement over the status quo with basically zero trade off of no cost, right? And that's really challenging to achieve. It's not impossible. I think Taproot demonstrated that it's possible. The big challenge I think is that the cost, even if there's no cost on node operators and there's no cost on miners, there's a cost on developers. So any kind of change to the Bitcoin software, any kind of addition to it, which is what a soft fork really is, means that maintainers of the code base have to maintain that for the rest of time. And so that is a cost. It's a negative externality on the software development community writ
Cool.
large, whether it's the core developers or wallet developers on top of that. Um, and that's really, I think, the biggest cost to any new opcode. And that is what causes ossification more than anything else is developer reluctance towards maintaining a feature for the rest of the time.
Yeah, it makes sense. Um, on the mining side, obviously, I mean, with the advent of these publicly traded miners, it's become a very competitive space. How do you is that a healthy environment? Do you see mining continuing to be a successful endeavor? Do you see it moving to a fee only kind of environment where fees have to rise in order for them to survive? Or do you see great advances in energy production coming that are going to allow them to keep mining successfully because they're just extremely lowering the cost of mining? Where do you see that future?
I think so. We got to separate two questions of what's good for the mining industry and what's good for Bitcoin.
Okay.
Because those are actually complete opposites. And that might sound surprising, but that's my analysis on the economics of the situation. So, um, what would be good for the Bitcoin mining industry would be getting rid of the halvings, right? To make sure that the miners continue to get the new issuance, and then having constant network congestion, right? Where transaction fees are super high, and even having censorship where transaction fees are being driven up because some miners are censoring transactions. And so those transactors are having to bid up their transactions to get into blocks. And so then we have a very high fee environment with a very high subsidy of new issuance. And the miners are very happy because that increases the total size of the industry, right? Um, Terrible outcome for Bitcoin users, right? Bitcoin users are getting diluted by the new issuance, and they're having to pay very high fees for sending transactions, and so that's bad for users. Um, so then diametric opposite. Okay, so then let's say no subsidy. By the way, Bitcoin nodes, Bitcoin users could soft fork out the new issuance going forward and say, all right, no more new issuance for Bitcoin miners. Very low fees, let's say, because either all of the activities happening in a SQL database, right? OGs holding at Coinbase or selling to BlackRock that's holding it at Coinbase. And so all of that activity is happening in a SQL database off chain. Or it's all happening off chain on the Lightning Network with semi centralized routing nodes so that there's very little channel opening and closing happening on chain. And that on chain is basically a barren wasteland of um, JPEGs that are very price sensitive. And so they'll only pay, a penny. And so the total mining revenue gets driven down to almost zero. And so there's a guy in his basement who's the only miner in the world on his parents' laptop, that is earning $20 a month in total mining revenue, right? And that's the whole mining industry is this one guy, right? That's actually a great outcome for Bitcoin users and holders, right? They're not getting diluted by new issuance. And if you do need to go transact on Bitcoin, it'll cost you a penny. Uh, and so that's Imagine that equilibrium outcome, right? And then if somebody tries to censor a transaction, some other guy in his parents' basement fires up his laptop, and now you've doubled the hash rate, and he's mining the censored transaction. Between those two extremes, right, of very high mining revenue and very low mining revenue, there's actually zero difference to Bitcoin's security model. And that is, I think, the part that boggles the mind of the crypto researchers who talk about the security budget. There's no difference in the security outcomes between those two. The security budget concept is completely fabricated as a way of having debates between altcoins and Bitcoin. There's actually no long-term risk to Bitcoin of, oh, will we have enough transaction fees or not? Like, that's
I thought that was, I mean, because
yeah,
this is really interesting. So you explain this to me, because I've always thought that you could attack the Bitcoin, do a 51% attack if you had greater hashing power. So if
sure.
there
But
was
then
one miner in the system, then
all
somebody
you
could
do
come
is
in
cause a rise in transaction fees, and then
because of
new
the
entrants come
difficulty
in, and
because
then
of the difficulty adjustment is what
yeah.
you're saying. Okay.
So because Bitcoin mining is permissionless, anybody can
Mhm.
contribute a hash rate. You can't
Mhm.
stop others from entering, and that is what makes it. So that's what makes it decentralized. Is that
Right.
there's no barriers to entry.
But
It's
it's what we're
not.
saying is the tension between these two polar opposite outcomes is what always keeps Bitcoin in this ebb and flow, and keeps the network sturdy and reliable and somewhat obviously resilient, but somewhat ossified to the point that it's not going to harm itself.
I would say. I mean, I wouldn't use the word ossification because I'd say it's a very dynamic, self healing, anti fragile set of
Okay.
incentives.
So I got you. Yeah, makes sense.
Um, and and then from the Bitcoin mining industry, they're a price taker, right? So at the end of the day, they don't care because if Bitcoin mining revenue is too low, they'll go do AI HPC.
Hmm.
They're agnostic. They don't care,
Okay.
right? So this idea that like, oh, we have to do them a favor by like finding ways to increase transaction fees. It doesn't matter at all. They're for-profit corporations. They've got lots of ways to make money.
Wow. It's unbelievable. I mean, do you think this is an accident, or do you think Satoshi considered all of this going in?
I think that it is emergent properties that are the result of keeping the design simple, and that um it's just a lot of it is just pure luck uh in the sense, but it's not really luck. It's just that if you set things up simply, and you yeah, then it emerges to be pretty resilient. The other part of it too, though, is a lot of deliberate misreading of Satoshi. So if you go read the white paper, it's basically saying like transaction fees can replace the subsidy. He's not saying that there has to be a one for one substitution. He's just saying that from the perspective of creating a block every 10 minutes, there's no reason why the system is gated and has some kind of uh dysfunction where you can't substitute, that there's no like way for the transaction fees um to be rewarding miners, or to that, that there's some kind of like mismatch there. He's not saying that like, and so like people read into Satoshi in ways that um are like almost, I want to argue, like emotional, of like, oh, it wouldn't be fair if the miners get their revenue cut in half every 4 years. Surely there has to be something that offsets that. Oh, the transaction fees have to double every 4 years, or the Bitcoin price has to double every 4 years in order to, make everyone whole. And so they have like a uh equity, uh, you know,
Mm.
uh DEI perspective on it, which is like,
That's it.
no, we don't owe the miners anything. They're
Right.
fine. Like they're for profit corporations. Like
Right.
uh, what we owe is a duty to the Bitcoin users, right? Because they're the ones who are actually setting the protocol rules with their Bitcoin nodes.
Yeah. So
So
in
I
that
think that
regard, you're
yeah.
I would assume that you're pro knots and more diversity and more diversification across clients.
No, not at all.
No,
I'm
not at all.
extremely anti-knots.
Really? Why is
I
that?
think that it's extremely irresponsible to run a piece of software that the release process is overseen by one person.
Okay.
Like
Okay.
uh, I am pro uh, um, doing if you're gonna do that, you might as well just download the source code, audit it yourself, review every line of code yourself, compile it, and then run your own node that way. Um, but relying on one person is much, much worse than relying on a set of maintainers. Um, and so I think what Luke Dasher is doing is extremely irresponsible. And people promoting the use of knots is, I to me insane. Um, Other than like unless you're a cybersecurity expert and you have it sandboxed in an environment where worst case scenario, there's a Trojan, a vulnerability inside of knots, and if there is, it's siloed, and so there's not going to be any knock-on effects on any of your other infrastructure. Then yeah, sure, okay, you know what you're doing, that's fine. But um, I find that part of the debate I find insane because
Interesting.
you can disagree with the way that the GitHub repo is being maintained, and that you want better governance within that in organization of Bitcoin Core. But to say that it's either, oh, the way I'm going to have better governance is to just abandon all governance and put my whole fate into the hands of Luke Dasher, it's just doesn't make any sense at all. It's like saying like, oh, the police sometimes abuse their power, and so we're going to put all of our security into the hands of gangs that have zero accountability, that are like g- uh whatever, might makes right, I don't want to use the word anarchy because but a chaos, right? Of just like, no. So, I think that it's good to advocate for reform of governance of Bitcoin Core. It's good to advocate for alternative implementations that have better governance. It is not good to advocate for alternative implementations that have far worse governance.
Right.
Like that
So
doesn't make any sense.
so in your perspective, if knots had better governance and a wider set of eyes reviewing the code, then you would be okay with the competition.
100%. That
What?
that'd be fantastic.
Yeah.
I think that would be great. Um, and but it's very far from that. So it's a very
Gotcha.
much a hypothetical.
Yeah, that's an interesting take. I appreciate that. Um, all right. So, like, before we wrap up here, I want to get back to the Bitcoin Bond Company. Um, where are you at in this in the construction of the company, offering products and working with clients? When might we you see sort of the first renditions?
Yeah, arguably never, right? Because at the end of the day, this product is not for retail investors, and so it's not, it's all private behind NDAs and behind closed doors, right? And that's just the nature of the product itself, and the target audience and investor base for it.
Okay, so it's safe to say that you're having discussions without having discussions.
Yeah, that's right.
Okay, well, Pierre, it's been a wonderful chat with you. I always learn a ton, whether I'm listening to you and now talking to you. So thank you for your time today. Do you want to leave people with some information about where they can find you and how they can follow you?
Yeah, follow me on X at Bitcoin Pierre. My DMs are open. Always happy to answer questions.
Awesome. Thank you very much.
Thank you,
Everybody,
Paul.
like and subscribe. We'll get more guests like Pierre here, and we appreciate your time today.
Bye.
So you've heard Bitcoin is the new gold rush by now. As world leaders on all sides have endorsed it as the future of money, and now you're looking to get started, we'll show you how. It's actually easier than you think. First, go to your nearest Byte Federal ATM and turn your cash to coin. Byte Federal has over 1,200 locations around the country with the highest daily limits. Go to our website, bytefederal.com, to find the nearest ATM to you. Log in to any wallet, then create an account, deposit your US cash, and instantly convert it to Bitcoin. That's it. We are the only US manufacturer and operator in the Bitcoin ATM industry, and our US-based live customer service is second to none. Go on, give it a whirl, and don't get left behind. Click the link below.